Hi, and welcome back to our Technical Analysis edition. My name is Violeta Todorova, and I'm Senior Research Analyst at Leverage Shares. Bond yields around the world have been rising again as global markets anticipated a likely wave of interest rate hikes by central banks this week. Sweden kicked off the week in style with a 100 basis points jumbo rate hike, the biggest in 30 years, bringing its policy rate to 1.75%. Today, the Federal Reserve raised interest rates by another 75 basis points for the third consecutive time. The central bank has been hiking rates by a previously unheard of 75 basis points in its effort to fight four-decade high inflation. The Fed first raised interest rates by a whopping 0.75 of percentage point in June, and Chair Jerome Powell said the hike was an unusually large one and didn't expect moves of this size to become common. Nonetheless, the third one for the year occurred today. The US Central Bank has already raised interest rates 5 times this year, for a total of 3.25 percentage points, the highest level in 14 years. The US economy hasn't seen rates as high as the Fed is projecting since before the 2008 global financial crisis. The Fed has declared inflation as public enemy number one, and supersized rate hikes appear to be the new norm. The Fed is likely to take their benchmark rate into restrictive territory and hold it there until there is evidence that inflation is moving down. Economists expect Fed officials to forecast their key rate could go as high as 4% by year-end. They are also likely to signal additional increases in 2023. Perhaps to as high as 4.5%. Global equity markets were bleeding after the release of US CPI data for August, which turned out stronger than expected. While a short-term rebound to unwind the oversold momentum conditions could be seen soon, our baseline scenario is for further weakness over the medium term. Thank you very much for tuning in. See you next time.